price of silver in Shanghai and in COMEX, New York. So the red line at the bottom shows us the price at COMEX.
Silver isn't moving because of speculation, it's moving because supply can't keep up with reality. For years, silver consumption has exceeded mine production, and that gap is still widening. Most silver isn't mined on its own, so higher demand doesn't automatically create more supply. At the same time, manufacturers can't afford to run out. Even 1 ounce of silver can shut down an entire production line. That's why prices can rise without resistance, and why the record gap between Shanghai and COMEX matters. When silver can't be arbitraged, it means it isn't easily available.
The price of silver in Shanghai and in COMEX, New York. So the red line at the bottom shows us the price at COMEX is $83.22. For silver, that's an all-time record. We closed on Friday at around $79.30, and we've opened this morning at nearly $84. So over $4 higher than the close on Friday. Now, that's a huge leap for the price of silver. If you think back when silver was sort of $30, we got very excited by a jump in price of 50 cents. So we just had a leap in price of $4 on that 79.30 price. It's gone to 83.22 at the moment in New York. Now, what's interesting is the Shanghai price has been climbing all morning since it opened around midnight European time. So we're looking at the Shanghai near-dated future here, and you see it's at an all-time high of 92.08. The chart we're looking at is a 1 minute by 1 minute chart here. Now, if I spread it out to a 1 second chart, you'll see that Shanghai looks like it's stopped trading at the moment. There you are. See this flat line here? That kind of looks like it's maybe it's a lunch pause. I don't know about Shanghai times, but it's temporarily paused, whereas the COMEX price is still moving around. I'll put that back to the 1 minute chart. I think we can look at it a little bit longer. Let's look at it. Yeah, I just need to adjust that so you can see that better. Auto fit scale. So as you can see, that shows us the difference between the Shanghai price, which is in green, and the COMEX price in red, and the gap in between the two is the difference. So it was very little difference, but as of now, the difference is at an all-time record, with from 92 to 83. That's nearly $9 of difference. It's got to be a record. Let me put that back to 1 minute chart now. So there we have the 1 minute chart. So in green at the top, it's the Shanghai price showing 92.07 at the moment, and in red at the bottom, showing the COMEX price of 83.23, both all-time records.
This move in silver is not just a rally, it's a repricing event. COMEX silver jumping from around 79 to above 83 in one session is extremely rare for a market that usually moves in cents. That kind of jump only happens when liquidity thins and buyers are forced to pay higher prices to find sellers. What makes this more important is Shanghai. While COMEX is trading in the low 80s, Shanghai silver is near 92. That nearly $9 gap is not normal arbitrage behavior. In efficient markets, spreads like that usually close quickly. When they don't, it signals constraints in physical availability or delivery willingness. Shanghai pricing is far more connected to physical settlement than Western futures. When it trades persistently higher, it suggests silver is being valued as a deliverable asset, not just a paper contract. COMEX, by contrast, reflects leveraged futures positioning and short-term flows. Notice also that Shanghai pauses while COMEX keeps moving. That effectively locks in higher physical valuation while paper prices continue to fluctuate. And despite reaching all-time highs, prices are stabilizing rather than collapsing, which suggests acceptance at higher levels, not rejection. This is not about headlines or hype. It's about where price discovery is happening first. When physical-oriented markets lead and paper markets lag, it points to structural stress in the silver market, not just volatility.
What's been going on with silver in particular? Well, first of all, for many years, about 4 or 5 years, the mined production has not been as high as the consumed production by industrial use. And the gap has been getting wider. The reason it's getting wider is mine production has been going down for 10 years, and it's going down because most of the silver which is mined as a byproduct of other metals like lead, zinc, nickel, copper, and so on. So the production of silver doesn't increase much unless the production of those other metals increases. That's the first reason. So the production's going down from the mines, but at the same time, demand has been rising. And the demand is coming from the electronics industry, which is a big consumer of silver, the solar panel industry, the automobile industry, and the weapons industry, all of which are said to use quite a lot of silver. And the amount of silver being used is not going down, it's going up. So every year, silver consumption has been rising, and so you have a widening deficit. That's the gap between what's mined out of the ground and what's being consumed. That deficit's been growing bigger. So where does the difference come from? Well, the only place the difference can come from is by recycling old silver. So that would be, for example, your granny taking her candlesticks down to the pawn shop to be melted down, or it might be an exchange-traded fund which gets net redemptions and sells silver back into the market, or it might be you or I deciding that we like the price and we take some of our coins to the coin dealer or bars and cash them in, and he will, if he's got too many, he'll send them off to the refinery and it'll find its way back to the manufacturers. But there's a second thing which I think is worrying manufacturers here, which is perhaps explaining the short-term rise in silver. Let's just go back to here, go back to the browser, and we'll bring up the silver price here so you can see where it's going at the moment. There's a second thing which is happening. Silver manufacturers are hearing about the shortage of silver, and whether this shortage is real or imagined, it doesn't really matter. There's a worry, and so they'll be all diving into the market saying, we can't allow our production line to come to a halt just because of the 1 ounce of silver we need per car, for example. So if you're manufacturing a car and it costs $50,000, whether the silver price is $100 more or $5 more, won't make that much difference. If it's $100 more, your car's going to cost $50,000 plus 100. So they can't let the production line halt for lack of silver. And hearing all these stories, I think a lot of silver consumers in terms of manufacturing are saying we can't rely on just-in-time supply chains. We need to secure enough silver for a bit longer than that, just in case we can't get our hands on it. So there's probably this rush going on by manufacturers to make sure that they're first in line to get the silver while they can still get it. And what's the evidence for a shortage? Well, the widening gap between the Shanghai price, here the green at the top, 92.08, and the COMEX price, 83.32, widest ever. This tells us that there must be a problem somebody's got a problem laying their hands on physical silver, because historically the gap has been 50 cents, a dollar, occasionally a bit wider. But when there's a gap between two marketplaces, the large bullion banks can simply pile a load of silver onto a plane, and it can come out of London or New York and be in Shanghai the next morning, ready for delivery to arbitrage away the difference. But that's not been happening. So why aren't there plane loads of silver flying to Shanghai to take advantage of the much higher price in Shanghai? Well, to me, I think the reason is the silver isn't really easily available. It's not there.
What this explanation highlights is a structural supply problem, not a short-term disruption. For several years now, silver consumption has exceeded mine production, and that gap has been widening. Mine output isn't falling because silver demand is weak, but because most silver is mined as a byproduct of other metals. Unless copper, zinc, or lead production rises, silver supply doesn't automatically increase. At the same time, industrial demand keeps climbing. Electronics, solar panels, vehicles, and defense manufacturing all require silver, and not usage isn't optional. Even small amounts of silver are critical to finished products, which means manufacturers cannot simply substitute it away or delay purchases. When mining can't meet demand, the market relies on recycling and existing above-ground stock. That means silver must come from ETFs, private holders, or old scrap being refined into usable form. But that supply is finite and price-sensitive. What changes behavior is perception of shortage. Manufacturers don't wait for confirmation. If production lines depend on silver, they secure inventory early, even at higher prices, because the cost of silver is negligible compared to the cost of shutting down factories. That's why the Shanghai COMEX gap becomes crucial. Historically, a small price difference would be arbitraged instantly by shipping metal. A record-wide gap that doesn't close suggests physical silver isn't readily available to move. That's not speculation, that's logistics. When price spreads persist and inventories aren't mobilized, it signals physical tightness beneath the paper market, not just rising prices.